with the daily insights that matter. We begin today's DITM by talking about the surge in the education loan book of the banks. Now, following the lull during the pandemic, Indian banks are lending to students seeking education loans at a rapid pace. Now, state-run banks are the major funders of student loans. Data from RBI shows that the bank's education loans increased by 12% during the 12-month period that ended on September 23, 2022. Now, when compared to the previous 12 months, there was only a 1% growth then. So what explains the sudden rise? While more students are opting for overseas education after the 2-year hiatus brought on by COVID, students are returning to college and other educational institutions as well. Furthermore, the state-run banks, which provide 90% of all education loans, the government is putting pressure on these banks to increase their student lending as well. Now, with the education loans on the rise, the question of bad loans arise because bad loans in the education loan segment are relatively high and are estimated to be around 8%. While the rising NPA in the education segment could hamper the growth of bank credit for higher education in the country, we don't believe that it will massively impact the improving asset quality which is already underway, as it forms a small part of the overall NPA under personal loans. Now, we do, however, think that corrective action is necessary and the banks may need to take a close look at the caliber of the education loan book as well. Now, according to projections by Morgan Stanley, India will take just another 7 years for its GDP to grow by an additional $3 trillion. Now, India's scale and size, clubbed with a shift in policy approach towards boosting investment, demographics advantage, and the public digital infrastructure are one of its key assets, which will enable it to be the world's third largest economy by 2027, as per Morgan Stanley. Now, India is on track to add more than $400 billion to its GDP every year. Only US and China have been able to achieve this feat in the past. Now, the report also projects that India's market cap will rise from $3.4 trillion to $11 trillion by 2032. Now, the estimates are supported by a convergence of favorable domestic and global factors and a shift in focus of policy from redistribution to nurturing investment and employment growth, which is clearly evident. Now, the GST's implementation and the massive success, of course, as we have seen, the corporate tax rate cut and the introduction of the PLI schemes are all examples of the favorable shift in the government's policy. Additionally, India has built a public digital infrastructure which is based on Aadhaar, while other economies have taken the private network route. Lastly, on a demographic standpoint, India's working age population is growing, which suggests that it will have a longer growth runway, as India's median age today is 11 years younger than that compared to China. So what does all of this news mean for you? The overall asset quality in the banking system has been improving, but education and bad loans have been high and the banks must take corrective measures to sort this out. This will therefore have an indirect neutral impact on you for time being. Now, India is entering a phase where incomes will be compounding at a fast pace on a high base, and India's real GDP is forecasted to grow at 6.5% over the next decade. This will therefore have an indirect positive impact on you. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.